Well, these markets can't seem to make up their mind. We have another head-spinning reversal to contend with, and that's not for any sort of this or that reason, apparently, because all of the macro shenanigans that could have happened today didn't. So what is it that these markets are doing, and why do they seem to have such a hard time holding up? That's what we're going to tackle here on Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. And we'll start as we usually do with a look at what happened in the price action and why the markets appear to be struggling to perform here. And from there, take a look at what came out on the event risk that might have inspired them today, and then see if we can't figure out what might be coming next. So let's first and foremost take a look at what these markets actually did. It was a relatively quiet day once we look at the numbers, but that belies how we got here. So the S&P down just a touch, NASDAQ more. In fact, the stock market today was kind of an interesting breakdown sector-wise, where all sectors but tech were up, but tech was down, and one would, I think, be hard-pressed to find a specific catalyst as to why tech. But it certainly lost ground today. NASDAQ here with a clearly weaker showing, down almost 0.7%. Yields continue to decline, giving us a kind of negative growth lead. Bonds, again, on the upside. Crude oil continues to leak lower, but at a slower pace, down 1.5%. Gold apparently has no regard for anything that's going on anywhere and for any reason. It just continues to inch higher. The euro a touch higher, so is the yen, but only just so. And Bitcoin, as ever, doing its risk appetite on steroids thing. Stocks are down, so it is down more, off just over 2.5%. What's interesting about all of this is when we look at the sort of internal dynamics intraday for how we arrived at this juncture, we find that we have a sort of strange way that these gains and losses ended up materializing. So what's nice about this chart from the Wall Street Journal is we can really start at where the sell-off began on Friday, and there's a number of interesting things that immediately jump out. So obviously the story on Friday was that the president said something that seemed like escalation of the U.S.-China trade war, and everybody got all kinds of hot and bothered, and there was a big sell-off. Here's Monday. This is the 13th right here. And obviously, we had a massive rebound, lots of comments to calm the nerves over the weekend. The president apparently walking back some of the worst of what he said, saying, Xi Jinping is going to reach the right decision. He just had a bad moment. The export controls that the president is raging about, that's just a mistake, and we'll figure it all out. It's going to be fine. That coupled with comments from Treasury Secretary Scott Bessent yesterday, today from U.S. Trade Representative Jameson Greer saying, how the president said that he's not going to meet with Xi later this month as scheduled? Don't worry, he is. They'll have a conversation on the sidelines of the APEC conference in South Korea. It's going to be fine. Everything's still okay. And so maybe it was even sensible to write off this as saying, okay, well, the market got afraid of a trade war, then that risk got walked back, so okay, everything's okay again. Then, of course, going into today's session, we plunged right back to these lows, only to climb back over, only to fade at the end of the day. So the markets are really struggling to find a lasting lead here. And as we can see, what's perhaps the most fascinating part of all of this is, first of all, since all of it began on Friday, we are on net down across all of the indices. So we're down on the S&P, we're down on the Nasdaq, we're down even on the Dow from where all of this began on Friday. But maybe even more fascinating still, Nasdaq has been the biggest loser. We can see here that whereas the S&P is down, it isn't down as much as the Nasdaq is, which is over 2%, and Dow is closer to flat than it is to really down in earnest. And so if what we're talking about here is a trade war, something that is ultimately a growth risk, it's very interesting indeed that the place where the most weakness is perhaps the place where that trade war matters least, in the place where you have these mega cap tech names. Because if anything is sort of relatively insulated, as we learned in spades, of course, during the COVID pandemic, if there's any place that's sort of semi-insulated, as it were, from the business cycle, it's this AI narrative, because it's not necessarily linked to near-term economic dynamics, to near-term supply-demand dynamics, to the near-term business cycle. And yet that's the place where the selling is most acute. If we take a look at the biggest losers in the tech space today, it's Intel, it's Nvidia, it's SMC, all of them kind of names, Oracle, names in the AI constellation of things. And so the trade war is, of course, a significant thing, but one wonders if it isn't more an excuse than it is a true catalyst for a sell-off that wants to happen, and for a market that's maybe finally found itself to be overdone and frothy. As far as the event risk is concerned today, we had a speech from Fed Chair Powell. He said mostly familiar things. Perhaps the most interesting bit here was that he said that we may be approaching the end of balance sheet contraction in the coming months. The Fed has been undoing its quantitative easing efforts for years now. It's always interesting to hear people say that the Fed just keeps printing money forever, when in fact the Fed has been unwinding that part of its policy response for quite a long time now. So we have perhaps a situation where that is actually ready to go the other way. So if the markets wanted to hear something dovish, here is that dovishness. So the Fed ostensibly saying here that it's ready to remove an element of tightening that it has been deploying outside of kind of the rates up or down dynamic that we've seen. And perhaps that's because, as we see from these comments, data has suggested that we have significant downside risks to the labor market. And this is, of course, a familiar narrative for how we managed to justify September's cut. In the subsequent Q&A after this, another interesting bit here saying that that sort of indeed the labor markets has softened considerably, but that the standard error on what is a neutral amount of job creation may be as much as 50K up or down, which means that we might have tremendous volatility in NFP data at this point, such that we might even get negative readings. And it's almost as if the Fed is out here trying to prime the markets for maybe we'll get a really ugly September NFP number once the shutdown ends and that number finally comes out. And maybe that's okay. Maybe that doesn't change the policy calculus for Fed officials, which of course is an interesting conclusion in and of itself. But the Powell comments didn't really seem to move the needle today. Expectations for the October cut still hovering at familiar levels, hugging the high 90s. The likelihood of a December cut doing the same thing. Obviously, it's gone up versus a week ago and certainly versus a month ago, but versus yesterday, not really a meaningful change. So Powell didn't really make a dent there. The big question, of course, still the disconnect between Fed policy expectations for next year. The market and the Fed are about on page for this year. We can see that the markets are baking in 40 basis points here, net of the 25 basis point cut that's already occurred. So if we consider what that means here in aggregate, the market has baked in essentially 40 of the 50 basis points that it sees coming. So that just reinforces that basically this is not 100% and this is not 100%. So there's a very narrow likelihood that things might get a little bit iffy relative to expectations. But obviously the market is very much convinced that all the things that are supposed to be happening are indeed baked in as expected. So, I mean, if we take a look at 39 basis points, that basically says that that we are going to get two more cuts at these meetings, that we have 50 basis points left before year end, now carries a probability of 78% collectively as a cumulative scenario. And so if we look at that relative to Fed policy expectations, this is in fact already in the market. So the real question is this for next year, where the Fed only has a 25 basis point cut on the board, whereas the markets have the better part of 3. So almost 70 basis points here. Obviously, that's at least 50, so at least double what the Fed has, and quite a ways in the direction of that third cut. 19 basis points out of the 25 that you need, and that's a 76% chance of a third cut. So the disconnect here very much left intact in the wake of what the Fed chair said today. We can see that what's become interesting here is that stock markets are getting soggy as the outlook gets more dovish. And so this is sort of the kind of dynamic you might expect were there to be a growth scare, which seems to vaguely line up with whatever conversation might be being had out of the U.S.-China trade war conversation. That's obviously first and foremost a threat to global growth, to U.S. growth. And what you have here maybe is some sort of a recession-ish dynamic that's starting to emerge, but it could just as well be happenstance, and we might still be in an environment where the market is sort of imbued with hopium, but the Fed is resistant. One thing that's certainly seeming to take shape here is the dollar is finding reasons to continue to go higher. It went higher as the outlook got less dovish. It has continued to go higher as the outlook has become more dovish, as if to say the dollar is back to its kind of haven type of status. And perhaps what this then all lines up to is indeed some kind of a cyclical concern, because here we have all put together a more dovish view from the markets, which speaks to growth risk, a stock market that's struggling to keep going, and a dollar that's finding support all the same. All this is starting to add up to some sort of a generalized risk-off, issues ahead type of a conversation. Unfortunately, we still have this government shutdown going on, so we don't have any economic data of substance to keep an eye on to inform this story. There will be a little bit of economic data out of China over the next 24 hours. Their inflation numbers are due. The expectation is we're still going to remain in deflation mode, 0.1% expected on headline CPI and negative 2.3% expected on wholesale inflation for PPI. China has been stuck in a deflationary malaise for 9 consecutive quarters now. And the situation obviously isn't very good. It basically speaks to a near total absence of demand. So perhaps the president has figured that if ever there was a time to turn the screws, this is that time. But China is defiant nevertheless. Also on the board, a bunch more Fed speak. The comments from Fed Governor Stephen Miran might be particularly interesting. He's sort of emerged as the anti-consensus voice, and not surprisingly so. That's largely how he ended up putting on pause his post as the chairman of the Council of Economic Advisors in the White House, a post he nominally still holds, but which apparently got put on pause for now while he is serving on the Fed. And clearly he's brought the administration's voice into the monetary policy conversation. And so it'll be interesting to hear from him what he's got to say, because that'll give us kind of the full breadth of what the conversation at the Fed looks like. Powell, for his part, said that there's a very healthy debate about policy given the situation of tension between the mandates, that is to say, the balancing of keeping inflation in check while also addressing the weakness in the labor market that the Fed has identified. On the earnings front, almost all of the names on the menu today beat expectations, but for BlackRock. And the price response, which I have in this box right here, kind of a hodgepodge. JP Morgan beat but was down. Wells Fargo beat and was up. BlackRock missed and was up. So a mixed bag here, and not really a macro narrative to be had out of these earnings. It would seem tomorrow, Bank of America, Morgan Stanley, PNC keep the financial theme going. We'll get a couple other names as well. So it'll be interesting to watch how that develops. We've pointed out before here that one of the more interesting bits here from FactSet is that the market seems to be rewarding upside surprises much less than it has been historically. In fact, about a third, 0.3% versus 0.9% for the 5-year average for a standard upside surprise, whereas it seems to be punishing misses more so than average, with a 3.1% average loss versus 2.6% historically. So there is seemingly some sort of a risk-off vibe, even in just the market's response to earnings readings, but at least over the past day, they haven't given us a clear macro lead. So exposure-wise, I am still very long the U.S. dollar. In fact, I've only added on. Sold some more Aussie this week, sold some more pound last week, sold some more Canadian dollar just over the past 24 hours. I've also added a little bit more exposure on the risk-off side and took the opportunity from the bounce today to put on a little bit of a put vertical in the NASDAQ. And at least for today, that seems to have been an okay idea. Still short crude oil as well. That continues to lose ground. And added a little bit to my long bond position, added another call vertical here. That continues to make headway at the long end, up a little bit more today and seemingly attempting to make higher highs. There was a little bit of a pullback at the start of the weekend, so I used that to add a little bit. So looking for that to continue. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.